Welcome to Phil's Gang video. I am going to try to explain to you today using my PT2 and a little chalkboard here about how the stock market really works. You really believe that these analysts and these stockbrokers and these planners, you really believe they're crap. When they tell you to buy and they have this story, the company's merging with another company, their PE ratios are cheap. How many times you heard, oh, buy the stock, it's cheap, it's cheap, it's cheap. It's always cheap. I've never heard once someone say the stock's too expensive. And how come every recommendation is a strong buy, strong buy? I never heard one say a strong sell. Everybody, again, remember, they're always trying to make money by selling you something. So how does the stock really work, and how does the market really work? 99.9% of the people who have 401ks or invest in the stock market have no clue. They are working on absolute trust with the worst criminals in the world. These are the sharpest, brightest, Harvard, Yale, Princeton. These guys are the brightest criminals. I remember years and years and years ago, I heard a story when I was on Wall Street, and this is a true story, that this gangster from Chicago, Al Capone, was invited to Wall Street. And he's, what I'm going to show you today, he was shown. And he said, my God, I'm in the wrong business. I'm in the wrong business. Now, Al Capone, this is a true story, said after understanding the stock market, like I'm going to explain it to you, said, I take all these risks. This is all I have to do to make money. I can get shot. I can go to jail. Wow, this is a better deal. Now explain why. Okay, let's take stock X, okay? And we've seen a recent drop. So a stock, you always notice, here's a stock at $80. So let's put the stock up at $80 over here. Okay, and the stock starts dropping. And it goes from 80 and it goes down to, let's say, down to $20 down here. Down to 20 bucks. Okay. And you ever notice that you'll see the recommendations all the way down from 80 down to 70 and then down to 60 and down to 50 down to 40 all the way down. They telling you when you look up the recommendations of the stock, they have what? Strong buys. So it's always strong buys all the way down. Even though it's going down, the recommendations are strong buys. Okay? So just remember this, all strong buys. Until it gets to the bottom. When it gets to the bottom, they switch it to a strong sell. Just the opposite, from strong buy to strong sell. Ever wonder why did they tell us to sell it on the way down? But instead, what do they tell you to do on the way down? They tell you to do something else. They tell you to cost average down. Okay? Cost average down right here. That's what they tell you to do. Oh, wow, I bought the stock. I can buy more at 70. Aren't I lucky? I can buy more at 60. I can buy more at 50. And then the guy will say, I'm going to call my broker and bring him home and have dinner. I'm going to invite him to golf. He's such a nice guy. I got this wonderful company, and now the stock's down to 50. I could buy so much more of it at 50 bucks. I bought it at 80. Now I can buy a lot more at 50. Wow, he's my best friend. Okay, so how does this all work? What does this mean? Well, let's take a look at what Main Street is made up, or Wall Street's made up. Okay, first of all, there's a building over here. And here's your Wall Street building, big high-rise. Okay, and you got all your banksters in here. You got J.P. Morgan, okay, all the gangster. You got Citigroup, you got Bank of America, you got all the big guys, okay, Morgan Stanley. You got them all, okay? You got them all in here. Wells Fargo, you name it, UBS. So they're all in this big high-rise. Now, obviously, they're doing something right because they're in this billion-dollar building, and they're making a lot of money. So that's where they are. Now, over here, you have another guy. Let's take this guy. We'll call him Pete. And he's in this building here. And he is called a specialist. Okay, and here he is. He's in this building, and here the guy will give him some hands here and some feet and this little bit of hair. Okay, and this guy here is a specialist, or called market maker. So the market consists of a specialist, market maker, and brokerage houses. Okay, and then of course the retail customer. This is you, retail. You got the retail customer. He's right over here. And that's the retail customer. Over here, okay, is what we call the wholesale customer. Okay. Okay. Now, why the wholesale customer? Because he buys everything at a discount. Wholesale customer. It used to be there was a brokerage relationship between this guy and this guy, the retail customer. Used to be very loyal to each other. Why? Because it used to be in the 50s, 60s, and 70s, before deregulation and discount brokerage, these guys would go out and they would find deep discounted stocks. A great company, okay, great company right here. And this is a wonderful company. And the stock, it dropped from $100 down to, let's say, $10. What their job was, they would go in and research and find out the only thing that's wrong with this company, why it went from $100 down to $10, is because of management. Well, management's going to get thrown out. And what they do is your broker watches this new management over 10, 15 years. And that stock, as the management gets better and they run the company better, the stock now goes from $10 back up to $80. And maybe over 15 years, you have about 10 stocks like that, and you make a lot of money to retire. That's how it used to be. And used to pay him $150 for every share you bought in those days, sometimes $200. That's what they made. And so $150 for every share you bought, and they lived a very good lifestyle. Soon with computers and technology came discount brokers. So all of a sudden, computers and all this information with a mouse, people could get more information on a computer than these guys are getting. That's right. With technology and computers and the software, that the information they used to have no longer is proprietary information. Everybody could get it. So they knew it. The industry knew it. So they had to cut down to $5 from $150 for every share, called discount brokerage. Well, they got to lift the lifestyle they're accustomed to. How are they going to do that? Look at their income drop. Well, they got smart and they said, look, instead of going buying these undervalued companies that drop from $100 down to $10 and work them in, and then all we do is take a commission, we better buy the stock first. And we'll buy garbage stocks, and what we'll do is we'll buy them cheap, and we'll put out these press releases, and every brokerage house right here, okay, would have we do a selling desk here, and you got all your stockbrokers behind it. And all these stockbrokers, their job was to sell a particular stock. So you'd have your manager on the floor over here. Here he is. And usually the managers are big guys. They're usually big bellies like that. And because they're just big fat slobs, most of them, okay, and they drink and eat, and they have a grand old time. So they tell every morning, the big guy, let's say, the J.P. Morgan, these guys all get together and say, what stock we're going to push? Well, we're going to push U.S. Steel. The manager then tells the brokers, here, you're going to push U.S. Steel, and whoever sells most of this dog, we're going to give you tickets at the World Series, or we're going to have a contest where whoever wins gets a new Mercedes. We want you to take this dog and sell it because we bought the stock first. So what we're going to do is take the stock that we bought at $5, and what we're going to do is pump it up to $20, and we're going to make a fortune, and we're going to sell it to the retail customer. All right, now that's how we got from $150 to $5 to discount brokerage. Who's this guy over here? He's called a market maker. What's that mean? Every stock has to have a market maker. They make a market in that stock. He knows at any one given time, and he has a book. Here's his little book right here. He can tell at any time, and here's his book, how many buyers and how many sellers. That's pretty important because he knows if the stock's going to go up or down based on how many buyers and sellers. And the way it works is U.S. Steel, we'll call this stock U.S. Steel, X we'll call it up here. No matter where you are, you could be in Argentina, you could be in China, you could be in Alaska, you could be in Boston. If you want to buy those shares and you call your different brokers, all these different brokers, All these guys, if you're going to, and let's say 500 people called that day, and among them all, they all want to buy U.S. Steel. Every one of them has to put the orders through this one guy. This one guy. He's the only guy in the world will ever know at any given time if there's more buyers than sellers or more sellers than buyers. Pretty important information. Well, they love to have that information because they buy too now. Because remember, no longer are they acting as broker. They buy the stock first, and then they mark it up and sell it to you, the retail customer. So they buy it at $5, and they sell it to you, let's say, at $50, okay? So they buy a whole bunch of it at $5, and they know when to buy it at $5, and you'll learn in a minute how to buy it at $5. And they sell it, and they make a fortune. But they always got to know when to buy and when to sell. Now, who would know that? This guy would know that because he's got the information, how many buyers, how many sellers at any given time. So here's how it works. So the market, it works very simple. So here's U.S. Steel, and the stock from U.S. Steel dropped from $80 all the way down to $40. At $40, it was strong buys all the way down, and they told you cost average down, cost average down. They said, what a wonderful deal you got. You used to own it at 80, now you can buy more at 40. Well, these guys want to get back in here because they want to buy the stock not at 80. They want to buy it down here, these guys, and sell it to you and mark it up to you. So what they do, when it gets down to $20, they'll call this guy over here. So let's just do this. So we'll take a little phone line, and they call him over here. And these guys, let's say they're all on the phone together, and they ask him, hey, the stock's at $20. How many sellers are left? How many buyers are still? There's still a lot of people buying in here. And he looks at his book. He says, no, I only have 3 left. 10,000 left. I only have 3 left out of 10,000. All right, well, here's what we're going to do. We're going to put from strong buy, we're going to change the recommendation to a strong sell because we want to scare out anybody that's left in there. And you say, how many are left? Oh, I got about 3 buyers, 3 people in the stock that are still buyers. Okay, we want to scare them out because when we buy it, we want to make sure not only we get the lowest price, but the stock's not going to drop down any further. So they come out, they all get together, and they print all kinds of, they call it painting the tape. They call CNBC, usually they have a relationship with CNBC, like a guy like Jim Cramer or something like that will get on the air and say, oh, man, U.S. Steel, you got to get out of U.S. Steel. A company in Argentina is falling apart. The government may take it over. Some lie is called painting the tape, and people get scared, and they start selling that stock left and right. So here's the retail customer, and he is running like hell from this stock, okay, and he's going out. And this another one's going. They're all leaving. All the retail customers are getting out of this stock because it's a strong sell. Now they asked this guy, as the book, are they all gone? Because we want to buy when everybody's gone because we don't want to get in at $20 and it drops back down. And he looks in his book and he says, no. He said, look, the stock is now at $10. Everybody's gone and there's not many people in that stock. There's not many buyers. Not many buyers. And the selling, when you put that strong sell in, all the sellers are pretty much finished selling now. They drop when you put the strong sell in from the strong buy. When you change the recommendation, it dropped from 20 to 10. I checked my book. There's hardly anybody in there now that's selling. All right, now we're going to buy. So what these guys do now, they come in and they buy first at $10, okay? Let's say $5. Let's say they really ran out of the stock, and let's say it's $5, okay? Now they're going to buy millions of shares at $5. And they have the information from him. There's nobody left in there selling, so they know when they buy millions of shares at $5, it's not going to drop lower. So they're pretty happy. So they got 1 million shares over here. Okay, 1 million shares at $5. Okay, so that's pretty happy. They bought this, an $80 stock at $5. Now they got to make a market in it, and they got to get that stock to go because they want to sell it to you at around $70. Okay, they want to sell it to you, the retail customer, at 70. So they're going to make the difference between 5 and 70. How do they do that? Well, they start their machine going where they start sending information over to guys like Cramer and other people on CNBC who get paid on the side to pump their stock, to get glowing reports. They're on fire, all that sort of thing. And then these guests you see on CNBC, they pay to get on CNBC to hawk, okay, and that's what they do. So remember now, the recommendation is still a strong sell. So now they buy the stock at $5, and now the stock starts going up. Even though there's a recommendation, as soon as it's a strong sell. So it's going up. The stock's going up from $5, keeps going up, and all the way up. Remember, you still have on there, okay, from strong buy to a strong sell. They don't change it. And that keeps going all the way up, strong sell, all the way up, strong sell, till they hit $70 right there. So the stock, remember now, keeps going up, and they're selling it, okay? Not a lot of it, but they're selling enough to people because they're promoting it as the next best stock, right? It's going to be a great stock. But this is where they really promote it, is 70, because now they made so much money. They bought it at 5. These guys all bought it at 5, and now the stock is up to 70. They made a fortune. They want to get out. But if they stop buying it, the stock will immediately drop right down to $5. I mean, it'll just drop in one day. So they got to make a market in it. So what they do is they change it to a strong buy. Right here at $70. Goes back to a strong buy at 70. And they recommend the stock. All these brokers, there's brokers contests going on. Whoever can sell most of the stock at $70, we're going to get you a World Series ticket, you're going to win a Mercedes, whatever. So now everybody's pounding the stock. All the brokerage firms, all their brokers, all their analysts, all the, you name it, everybody's pushing it. Now the stock, all the retail customers come blasting in. All the retail customers, they can't buy enough of this. And they are buying and buying and buying, and the stock is going up from 70 to 80. Now, why is it important for them to get to 70 to 80? Because all these guys have got to get out, and they don't want to get out and the stock drop. So here's the big pool of money right here. This is how it works. Between 70 and 80, right there. Tremendous amount of retail money comes in. So now these guys over here start selling quietly. So they start pulling their money out, and they keep pulling their money out. And they keep remember now, because now it's at the $80. They bought it at 5. They're making a bunch of money, but they're recommending to you right over here, the retail customer, hey, you get in here and buy it. So they keep getting it. Now remember, they bought it all the way up. So they got to keep this game going up. So that's why they got to keep this game up. So what they got to do is convince you this is a great stock. If you bought it at 75, you want even more of it at 60. That's called cost averaging down. So and the reason is to keep the stock up so these guys can keep getting out. And that's what they do. All the way down, they keep getting out. They keep getting out. So the retail customers in here to hold the stock market up, and that's why they tell you to cost average down. Now when the stock gets down, again, down to $20, and everybody thinks they did a great deal cost averaging down, buying the stock less, averaging it out. They didn't know they were getting screwed. So now they're all out. So what do they do now? All the money's in their pocket. They don't have any more room for money. Now they start again. They change the strong buy all the way back down here. They change it now to a strong sell again. Because why? Because now they got all their money. They made a fortune from $5 to 80. They want to get back in again, into the casino again. So once again, the game starts. They put in a strong sell. Why? Because if they're going to put their money back in, they want to make sure when they put it back in at $20, the stock's not going to drop. So they contact their little friend here and ask him, hey, how many buyers? Again, how many buyers or how many sellers? So now he says, well, we got the strong sell going. They're all running out of the stock. And, hey, the stock's now down to $10, and there's not any sellers left. So they start buying again. Well, what does he get out of this? Well, he's a buyer too. He wants to be on the right side of the stock. He's in here buying with him. Well, what he wants to know in return for the inside information he's providing here as to how many sellers or buyers there are, that's like you have a relationship with the blackjack guy, the card dealer in Vegas. If you know what the down card was, you'd be good friends with him, right? Well, this guy wants something in return. While this goes on, remember, there's always announcements, downgrades. A company is in trouble, or a company, their product fell apart, or it's not working, that brings the stock down. When he's in the stock, he said, look, I'll tell you how many buyers and sellers so you can get in right, but you got to always tell me why I'm in the stock. Any announcements are coming up. So that would hurt the stock price. I want to be out before those announcements come in. Deal. So they have a love affair, these two, okay? So these guys have a love affair with each other because they share information that's valuable to both of them. So they have this great little love affair. So That's how the market works. That is called a cycle in the market. That's why people always buy high and sell low. You ever hear that saying? We always tell you buy low and sell high. But 99.99% of the people in the stock market don't make money because they always buy high because they get caught in this cycle, okay? And this cycle just keeps going on and on and on. It just goes up, comes back down. And who's the sucker in the game? Always the retail customer. He's the sucker in the cycle. He's always on the wrong side. That's why he always says, you know, the minute I got in, it goes down. When I got out right here, when it came in with a strong sell recommendation, it went back up. And that's where that comes from. So how do you protect a retail customer so that doesn't happen? Technology. With today's technology, we have developed the PT2 chart. It tells us every time when money's going in what these guys are doing. We follow their money. And here it is. When it's red, they're taking money out. When it's green, they're putting money in. We can do that with any stock. We can do it with any stock that you're involved in. We can do it with General Motors. We can do it with, you can see right here, look, it just turned red. Just turned red today. They're pulling their money out. We can do it with Apple. It's a popular stock. Look, on the way up, it turned red to green. Okay, then we can tell you when they're taking their money out. We can do it with 3M. Okay, you see, now here's a great example. The money's going in, and now the money's going out, see? So you're not going to stay in when it comes all the way down, cost averaging. That cost averaging down is a criminal offense. Any broker that tells you to cost average down to get your average cost of your purchases down should be in jail. So that's why we have designed, and we have thousands of professionals using our individuals and professionals that use the PT2 so to protect themselves so they're always on the right side. They're never saying again, hey, the minute I got in up here, it went down. The minute I got out, it went back up. So I hope you enjoyed this little explanation of how the stock market works, what the cycle is, and why you always hear people always buy where? They always buy wrong. They always buy at the top at 80, okay? And they never buy down here at $5. It's just a cycle. They buy high and they get out low. This switches it where you're buying low and you're getting out high with all the professionals who are over here in this big building. And the reason why they got big buildings, because they control the casino. But technology today lets us see what they're doing and we follow them. Look at this, green to red. I hope you enjoyed this. We'll see you on the charts.